Ajay Bagga and Amit Nigam, they both join us, market veterans. And Ajay, it's strange, right? I mean, just when we discussed that there were no concerns in the world and markets only headed higher, we hit the pause button. In the morning or on Monday, we were discussing, oh, dollar index has gone higher, bond yields have started recovering. Will there be a sell-off in the bond market? And the Nifty is up 100 points today.
Yeah, bilkul. And I think, Nikunj, it's really surprised. Yesterday, the thesis would have been lower lows are being made.
Exactly.
And are we in trouble? Is it cracking through 8,500? And the market has obliged with a good bounce back today. So I would go back to your starting point that fundamentally this is a good market. It is a recovering economy. Global issues are there. You can these change from Greece to Argentina to Turkey, and now Brexit again revisiting by March, or a Trump presidency which seems to have gone out of as a big scare. But I think Fed and Brexit remain the issues, but are they discounted in? And if you look back at the domestic markets, the domestic scenario, we are looking at another rate cut hopefully. We really did not rally so much despite the RBI cutting the rate, which was a surprise. And the economy is on the mend. Right now, what will happen is, first, you will see the corporate balance sheets getting restructured, getting better, and then the capex cycle happens. Maybe another 4 quarters before you really see a roaring capex cycle coming back. 99, when this happened, it took 4 years for the capex cycle to revive. So we are expecting another year maybe. We have seen 3 years of very slow capex. Maybe a year away, but markets will front-end it. So again, I would say fundamentally time to pick up good stocks in this market with a longer horizon. Trading portfolios will get really whipsawed. You're seeing all the technical analysts, they're going wrong on a 2-hour, 3-hour basis. Leave aside, on a daily basis, very difficult to trade in this market. But pick up the good fundamental stocks, you would be selling.
The only thing I'm reasonably sure of in the short term is that volatility will only go higher.
Yes.
I mean, global volatility is in late double digits, early double digits. And I've got the US presidential election, which is more like a popular debate, but markets are, I guess, undermining the impact of a referendum in Italy. So Ajay, I think in coming days, we can safely predict that volatility will be higher.
Definitely. There is a lot, and there is a domino impact, enough and more analysis out there that if Brexit goes through as a hard landing, which is what the French want and the German wants, they don't want the British to have a free ride on a single market, but not allowing immigration on the other side. So it's going to be a hardball negotiation. And with the Italian referendum coming up, with the Prime Minister losing a lot of his popularity, I think there are a lot of dominoes there. Merkel will not be there in Germany next year. She's probably losing the election on the portents that are there. That will cause even more uncertainty. She's been a stabilizing force on the continent. So a lot of those issues. But again, we would say come back into the domestic thesis. Yes, we will get a bit of contagion from abroad. Argentina, for example, as I keep saying, is lesser market cap than our biggest company. But whenever there is a small quiver in Argentina, our markets react in emerging markets. Yesterday, the Turkish party, AFK, they got a huge referendum, 49% of the vote. The lira went up 4%. But we didn't see a commensurate reaction in our markets. We went down. I was thinking yesterday we would get a foot up with the emerging markets coming. Maybe we have got it with a lag. So difficult to explain what's causing the market today.
When people talk about the Argentine comparison, I always say that I'm the bull and I like to give back the Apple and the Google comparison, that you add those two companies, they are just more than the market cap of Accio. Indian market cap is less than them. So Amit, let's talk about what's going on in the banking sector. First it was the JP Group, then the ADA Group, now SR. Yes. Serious deleveraging has started. Corporate India, in the last credit cycle, they expanded the balance sheet. Right. Now they're contracting the balance sheet. Good guys are getting some money back, yes, and banks are now confident of the cycle picking up. Right. So do you think now it's time to remain overly optimistic, not on retail banks but wholesale banks?
Sure. So for example, yesterday's big deal that we all read about in the media it clearly shows that the corporates which are over-leveraged and the working environment was getting incrementally tough for them, they have been forced to deleverage. And this only frees up the balance sheet and the NPA problem which was there staring at a lot of corporate lenders. So they were there both in the private space as well as public space. With such a freeing up on the balance sheet side, we will see the banks push up their, let's say, risk on behavior, but it may not happen immediately. They will probably wait for the demand to pick up at the consumer level, and therefore the corporates get more confident about the capex. Well, if I pick up a lot of industries today, Nikunj, the capacity utilization is still nowhere close to peak capacity utilization level, and therefore, as Ajay said, that it will be still some time before the capex picks up. But the good thing is that the balance sheet is getting corrected.
For next 2 quarters, are you betting on consumers, or you think that you want to be early bird in some of these cyclicals and industrial names?
So if you see, structurally we have been more focused on the companies which are more B2C. Selectively we are looking at some B2B names, which is what we call as cyclicals. Wherever we have confidence that the balance sheet is going to be in a much better shape over the next 6 to 12 months. So we are definitely looking at that space. But I still believe that the capability of being profitable through cycles is what is far more important when we choose our investments over longer term than trying to be nimble-footed and capture all these opportunities which happen.
Okay. Ajay, let's be real. You know the markets and you're a market veteran. Gains are made when you buy distress. Only distress I can see in this market is IT. And Nandan told us in the morning that forget about old tech, new tech. There is a generation change in the tech, and that is coming at a disruption, which is having impact on India, but Indian companies will survive and they will revive. So someone who believes that, look, I'm not bothered about 16, let's start thinking 2018. Is it a good time to gobble up a TCS or Infosys?
I think so, and I'll give you 2 reasons. One, Warren Buffett today owns 8% of IBM. Everybody is panning him for that.
Apple also after that.
Yes. And it's gone down. 16 quarters of decline with IBM. Yesterday, if you look at the results, but the good thing was, Nikunj, 44% year-on-year growth in the cloud business, 16% year-on-year growth in their what they call the strategic business, which is largely cognitive business, which is analytics, big data, and cloud. Now, what I have been saying in all your forums continuously, 2 things. Our companies are sitting on cash, they don't do anything about it. IBM this year itself has spent $12 billion on acquisitions and capex, $6 billion in share buyback. Why aren't our big IT companies doing that? They are putting 30,000 crores in liquid funds or in fixed deposits at 8%.
You know, that's a good thing to say if you're a mutual fund at a Morningstar conference. The mutual fund managers love to hear that, right?
But
they want that money.
So, you know, if they can use this money better, you know, a 100 million startup fund and all is just very small for the size of the balance sheets. They have to aspire to be the next IBMs. They have to, the business models are changing, for which you need better management, you need a different management, and you need a more risk on where you use this cash which is sitting. Third, Nikunj, even if you value them as utilities, that they will throw up this cash, which is one of your theses, we have discussed it earlier, they are pretty good because the managements are very good. They are not thieving managements, they are good managements, they take care of the minority shareholders. So I would say maybe yes, it is a good time. What surprised me was that we had forecast that October you will get management downward revisions, and still the stocks reacted 5%. That took me by surprise.
So again, you know, just to wrap up today's discussion, I guess technology is where what worked, the life cycles have got squeezed. So the same business which took them higher and give them higher growth is compressing them right now. But the important thing here is that the management is right, and whether it's a Chandra or whether it's a Vishal Sikka, they understand the dynamics and they can reboot them.
Yes.
So that could be a reasonable assumption, right?
That's right. Okay. That's right.
So gentlemen, I know we've dragged you out of the conference in the middle of a session, so hopefully I'll connect with you once the show is over. Sure. But thank you for joining us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.